Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 145 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today we are going to be talking about your mortgage. And even if you don't have a mortgage, or even if you don't own a home, this can still be a useful conversation for you because one of the biggest indicators of long-term wealth generation is owning a home. And part of owning a home in many cases is having a mortgage of some kind. And so we're going to talk about your mortgage, talk about how your mortgage fits into the financial action plan, how it fits into the debt repayment plan, or if it even fits into the debt repayment plan, and how we should go about paying off our mortgage and why. And I think this can be a really good conversation for all of us who plan to build long-term wealth and plan to become financially free at some point. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything that you leave down there. If you're listening on Apple or Spotify podcast, then be sure to subscribe and leave me a review on either one of those platforms, and that would be really helpful for me. Also, follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you walk through your financial life and create a financial plan that is specific to you and your family's needs, I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So your mortgage or your home, right? Maybe you don't have a mortgage anymore, in which case I would say bravo, or maybe you don't have a mortgage yet, where maybe you are renting or whatever it may be for your current housing situation. But it should be on all of our lists to own a home at some point. And when you own a home, or even when you don't own a home, even when you're renting and things of the like, your biggest monthly expense is typically housing, right? Your biggest monthly expense is typically either your mortgage payment or the rent that you pay. And so you see how big of an impact your mortgage can have on your ability to build long-term financial success, because it is going to have such a real impact on your budget. It is going to have an impact on the money that you are bringing home every week or every 2 weeks or every month, whatever it may be, because most of that money that goes towards your expenses is going to be going towards your mortgage. And that is okay for some period of time, but it can also be problematic. And the reason that it can be problematic is because when we get older and then, we retire or whatever, it is far easier to get rid of expenses than it is to create income to fund the expenses that we have. So for instance, it is far easier to get our home paid off and not have that expense and not have that monthly cash outflow than it is to create the income to continuously make that house payment month after month. It is far easier to do the prior than the latter. And so we want to get in a place where we actually do get our mortgage paid off. And when it comes to how we choose to go about paying off our mortgage, you may look at yesterday's episode and go, well, why don't we just put it in there? Why don't we just put it in with the entire debt repayment plan? Why would that not make sense? Why don't we just, plug it in and, just say, hey, make that the last debt that you pay off? Well, it is the last debt that you pay off. That is how we believe to go about it. But it is not a part of that fourth part of the financial action plan, and it is not a part of our regular debt snowball debt repayment plan. And the reason is that mortgage debt is just different. And a mortgage is just different, right? It is not like your other consumer debts. And I'll really dig into all the reasons why that is. Reason one that mortgage debt is different is because mortgage debt is the only type of debt where you can look and go, well, I was going to pay for that anyway, right? So you can really look at mortgage debt and go, well, I was going to pay for housing anyway, and so I took out this mortgage, right? I was going to pay for housing anyway, so I took out this particular type of debt in order to pay for my housing. Now, that's not the biggest reason, but that is obviously the first. I would either pay rent or pay a mortgage anyway, and so might as well go ahead and do it in this way. And then obviously the other way that you could do it is paying for a home in cash, but that is so difficult and takes so long. We don't want to take away from your ability to build long-term wealth. We don't want to take away from the time that it's going to take to build up money to pay for a house in cash So taking out a mortgage is not so horrible relative to other types of debt that you could take. Another reason that mortgage debt is different is because homes actually go up in value typically, right? Homes are typically appreciating assets. And over time, if the value of your home is going to increase and you took out debt for your home and ended up paying a certain amount, let's say you get it paid off, well, the value of your home can still increase after you paid off your home. And that can be very advantageous. And so we can be financing an appreciating asset. Whereas most of the other things that we would ever choose to finance are going to go down in value. For instance, the absolute best example of this is anything with motors or wheels, right? You're talking about cars, RVs, trucks, vans, SUVs. Obviously, that goes with cars. But RVs, four-wheelers, ATVs, side-by-sides, all those types of things, fifth wheels, all of these things are going to go down in value over time. Unless you get some car that just turns out to be a classic, turns out to be an antique that people will pay more for later. But that's a real crapshoot as to whether or not you will get more for it later on, where it is statistically proven that homes go up in value over time. Over a long period of time, housing prices increase. And that is important to note when we are taking out a mortgage because it is debt on this appreciating asset. But why would you take out debt on an asset that is going to be depreciating, right? Why would we take out debt on a car that is going to go down in value? So you're going to be making payments, right? You're going to be making these fixed payments on something that is decreasing in value. So you're going to end up paying not only whatever it was worth at the moment that you bought it, but you're going to pay that plus interest. And it is going to be worth far less once you finish paying it off based on the amortization schedule. And so mortgage debt is different in that way. It is not a depreciating asset, which we definitely like. Also, mortgages are big, okay? And it was a part of what I talked about in the first part of why mortgage debt is different. But mortgages are big. And when you take out mortgages, it is likely going to be the biggest debt that you ever have. And yes, we want to get that debt paid off, but the fact that it's on an appreciating asset makes it to where it is not as vital that we get it paid off. But it is so big that if we spent so much time paying it off along with the rest of our debts, then we would be in a place where we didn't give ourselves adequate time to build long-term wealth in our retirement accounts, in our brokerage accounts. We wouldn't have enough money set aside to pay for our kids' college or things of the like. We would not have the ability to do that because we spent so much time and money on paying off the house. Now, do I believe in paying off the house? Obviously, I believe in paying off the house. It is part of the financial action plan. We have talked before how the financial action plan, after you pay off your consumer debts, you build up your emergency fund to 4 to 6 months of expenses. You go and you begin investing at least 15% of your income towards your future in the way of retirement accounts, HSAs, brokerage accounts, your children's college accounts, all of those types of things. And simultaneously, while you are investing at least 15% of your income, you should also be putting extra money on your mortgage. Now, you also don't need to have a mortgage until you are out of other types of consumer debt. So if you are currently renting and you have consumer debt, you don't need to go get a mortgage until you are out of the other types of consumer debt. Why? Because again, this is the biggest drain on your cash flow that there is. Housing is the biggest expense that you typically have month to month. Why would you add a huge expense on top of debts that you already have, right? Why would you have these things that are sucking away your cash flow and add another thing that would suck away from your cash flow? Why would you do that? Doesn't make a whole lot of sense. Now, some people might say, oh, well, renting is just so much more expensive than buying a house. Why shouldn't I just go buy a house? Well, have you ever thought about this? When you rent, when things go wrong, and things do go wrong, then who pays for it? Not you. Right? Pipe bust, you don't pay for it, right? Gutters break, you don't pay for it, right? Something's leaking, something breaks, anything, right? You don't pay for it. Whoever you are renting from pays for that thing. So even though renting may be nominally more, the cost associated with owning a home is obviously higher. It is going to be higher over time. Your heat and air goes out, you are on the hook, not whoever you are renting from, because you're not renting from anybody if you have a home mortgage. And so don't take out a mortgage until you are out of that place where you have other consumer debts. And then obviously you want to build up your emergency fund, because if you have an emergency fund, then those things that we just talked about aren't going to be such a big deal. When you have an emergency fund and your heat and air goes out, yeah, it stinks, but you can pay for it. Or when your gutters leak, then you can change out your gutters, or you can replace your gutters or fix them, whatever you need to do. Or when something happens with the foundation of your home, then you can get it fixed. Whatever it may be, as big or as small as it may be, whatever emergency comes about, you can pay for it in cash, and you don't have to worry about the fact that the cost of home ownership is higher. And you may say, well, if the cost of home ownership is higher, then why would I even do it? Well, because it is an appreciating asset, and once you own it, you never have to pay for it again. If you just rented forever, you would just rent all the way to oblivion, and you would continue to pay rent. But when you own something, you can own it outright, and nobody can take that away from you, and that can create some financial stability for you, and it can decrease your costs, especially as you age, and especially as you get closer to retirement, because the last thing that we want is that large payment sticking around for a long period of time. You want to get your biggest expense gone, because like I said earlier, it is easier to get rid of the largest expense that you have than it is to create the income to pay for that large expense over time. And so we want to get rid of that large expense, and then once we have that gone, then we can build wealth over the long term and not rely on as much income in order to live the same lifestyle that we would choose to live anyway. And so our mortgage debt is also different in the way that mortgage rates are typically pretty low relative to the other types of debt that you have. Especially right now, rates are outstandingly low, right? You can get a 15-year mortgage for less than 2%, which is just, it's crazy. The rates are absolutely low. That's almost like just borrowing at 0%, which we've talked about borrowing at 0% when it comes to your cars or things like that. But low interest rate debt, you don't just want to jump into it just because it is low interest rate. You want to jump into it because you are ready to purchase a home. You are ready to buy a home. And so let's talk a little bit about, we've talked a little about why this type of debt is a bit different from the other types of debt that we can have. But let's talk about how we should actually go about purchasing a home and why I say that this is the way you should do it. So what you should do is you should try to take out the shortest length mortgage that you can, where you can keep the payment at or less than a quarter of your monthly take-home pay. And so what that's going to do is that's going to allow you plenty of margin in the rest of your budget in order to do the things that you need to do, like invest, like put money away for your kids' college, like give generously, like spend money on the things that you want to spend money on. And so it's going to give you a little room while still allowing you to pay your home off in a timely fashion. And so obviously I said the shortest mortgage that you can. I like a 15 or less year mortgage, because if you have a 15 or less year mortgage, then you're going to save a ton of money relative to the 30-year mortgage that these lenders are just giving out like they are lollipops at the bank when you're with your parents, right? They're just giving out these 30-year mortgages, but those 30-year mortgages become extremely costly over time. And we want to get our mortgage paid off as quickly as possible. And so having a shorter term mortgage is, one, going to force you into paying your mortgage off quicker than 30 years, because a lot of people want to say, oh, well, I'll just get a 30-year mortgage and pay it like it's a 15 or pay it like it's a 10. Doesn't really work out. If you get a 30, you will typically pay it off closer to 30. If you get a 15, you will typically pay it off at 15 or less, right? Because you're not going to go past 15. 15-year mortgages get paid off in 15 years, but 30-year mortgages, there is no guarantee there. And so get the shortest term mortgage that you can. Typically a 15 years is what we want to look at. And people would say, well, why would you do that? That's going to make for a higher payment, and it's going to be more costly. Why would you get a 15-year mortgage? Because we are trying to get this out of our life. That way, when we get our home paid off, and we do want to get our home paid off, and they're like, well, why would you want to get your home paid off? Because again, we want to get rid of that biggest expense that we could have, because creating the income is more difficult than actually paying off the things that you need paid off. Decreasing your expenses is easier than creating the income that you need. And so let me just give you this quick example at just the dollar amount cost difference between the 30-year mortgage and the 15-year mortgage. So if you took out a $250,000 mortgage and you had a 30-year mortgage that was at 3.75%. I know that's higher than what we have currently, but what we have currently is not going to stick around forever. So let's say you have a 30-year at 3.75%. and it's a $250,000 loan, your monthly payment will be $1,157.79, which turns into over 30 years, over $416,000 that you ended up paying for that $250,000 home. So that means that you ended up paying $166,000 plus in interest, right? But if you take out the same loan, the $250,000 loan, on a 15-year at 3%, which is a reasonable gap between the 30 and the 15-year rate, then you will end up paying $1,726.45 per month, which obviously is, mathematically correct. The payment does go up with the 15-year mortgage, but you end up spending $310,761.74 over the course of 15 years, which is $106,000 less than what you would spend with the 30-year mortgage. Now, I understand the argument of, oh, well, you could just, invest the difference and it would grow and you would have more money than that difference. Yeah, I get that. I 100% get it. But you could save yourself real money by doing this, or you could work out whatever that theory is and try to put that in practice, even though that is far more variable than just paying your mortgage. Paying your freaking mortgage is what's important to you, and it's going to be something that gets done. You may or may not do that little theory that you have about investing the difference. Not to mention, you make some rate of return assumptions there that may not end up stacking up. Not to mention, you are, again, trying to create income instead of getting rid of expenses. I'm okay with creating income, and I want us to do that. That is a part of the financial action plan. We want to build our long-term assets. I'm all for that. I get it. But if we are doing that in lieu of getting rid of unnecessary expenses, then I'm not for it, because getting rid of unnecessary expenses, especially the biggest ones that you are going to have, is what you need to be doing in order to reach long-term financial freedom. It is proven time and time again. Millionaires, Chris Hogan's book, Everyday Millionaires, he goes through stats of what millionaires have actually done in America, right? They did the largest survey of millionaires in North American history, over 10,000 millionaires. And what did they find? They found that if you were a millionaire in America, you did that survey, the average millionaire was paying off their home in less than 10 years. And so if you want to be a millionaire, what would you also want to do? Pay your home off in less than 10 years. Don't listen to theories. Sometimes, again, I love mathematics. I love math. I think math works, right? I totally get the math behind the arguments that people have. But the difficulty with the math is that the math doesn't control your behaviors, right? Having a 15-year mortgage instead of a 30 controls your behavior, because now you're forced into paying that 15-year mortgage and you don't have that ambiguity. You're like, oh, well, I can just not pay extra on that 30 this month and do this, that, or the other. I can just, not invest the difference and, these types of things. It leaves less up to the imagination, and it leaves it to where you are forced into certain behaviors that are going to be good for you over the long term. And that is what we want as safeguards between you and making bad financial decisions. Now, obviously, even with a 15-year mortgage or a 10-year, whatever you have, right? Even with a 15-year mortgage, you still need to be trying to pay your home off early. Or if you have a 30-year mortgage already, especially if you have a low rate right now, there is no reason to go ahead and refinance to a 15. Just start paying extra on that mortgage, right? Really get after paying extra on that mortgage over time. And that is part of the financial action plan, right? After we're paying 15% to ourselves, we're investing at least 15% of our income towards our future and our children's future. Once we're doing that, then we need to be paying extra on our home with any extra cash flow that we have. And in doing so, that can really decrease your costs on that 15-year mortgage, maybe even less than that $310,000 on the $250,000 mortgage that you took out. And it will really make a lot of difference. And just think about once you have that paid off, and let's say, you're 25 years old, right? I'm 25 years old. Let's say you're 25 years old and you take out your first mortgage. It's a 15-year mortgage and you pay that mortgage off in just 15 years. Well, now you're 40 years old with no mortgage. You're nowhere near retirement and you have no mortgage. Think about how much wealth you can build with no mortgage. Think about how many things you and your family can do if you have no mortgage. And so you see how it is so just advantageous to go ahead and do that. Because let's say you're 25 years old again and you go and take a 30-year mortgage out and pay that off in 30 years. Well, you'll be 55, so either at or really close to retirement, and you will have spent all this extra money on your home over time that was unnecessary to spend on it, and you would have done so in lieu of being able to do other things with your cash flow over time. And that just doesn't sound like something that I'm interested in. I want to pay my home off relatively quick and then be in a place where I can use all that excess cash flow I have to build wealth, give, and spend money the way that I want to. So then the question becomes, how can we go about paying off our mortgage early? So I want to give you some ways that you can actually do that. Right? I want to give you some ways that you can actually go about paying off your mortgage earlier. And so one way is bi-weekly mortgage payments. Now, I know most of you, your mortgage payment is due once a month. But something that you can do that would be advantageous to you is that instead of making that once monthly payment, which would be 12 over the course of a year, right? If you made, let's say you took half payments, right? Let's say you get paid every 2 weeks. That would be a good assumption to begin with here. If you get paid every 2 weeks, that means you get paid 26 times a year. Well, let's say every time you got paid, you made half a mortgage payment. Okay, so you make half a mortgage payment every time you get paid. That means over the course of a year, you end up making 26 half payments. Well, that's 13 full payments instead of the 12 full payments that you would have made otherwise. You tracking with me? And so you end up making one more full payment over the course of the year, which will get you closer to paying off your debt quicker. And so that extra payment can knock 8 years off of a 30-year mortgage, which is outstanding, right? And that really depends on the loan's interest rate, obviously, but it can knock off a lot of time off of a 30, and it can knock off time off of a 15 as well. Now, obviously, this is something that you're going to have to work out with your lender. Make sure that you can do this because obviously you can make extra payments towards principal over time, and I want you to be doing that. But I want you to make sure that you can actually make these bi-weekly payments and work this out with your lender. And if they will allow you to do it, it will be far more beneficial to you because you are taking out some of the interest that you would end up being due over time and making more payments towards principal, which is exactly what we want. So let's just use an example. Let's say a $220,000 mortgage that is a 30-year mortgage with a 4% interest rate, right? Obviously, interest rates are lower now, but they're not going to stay that way. How can we pay off our mortgage early? Well, make an extra house payment each quarter. Okay, so instead of doing that bi-weekly thing, let's make extra house payment each quarter. And if you do that on a 30-year mortgage, you would pay off your mortgage 11 years early and you would save yourself over $65,000 in interest. That sounds really, really advantageous. That sounds really good. We can, spend less on interest and decrease the amount of time that we would be paying on a particular debt. I love it. And then you own your home. Perfect. Then let's say something as simple as bringing your lunch to work. And you may say, I hear these type of things. Don't buy your daily Starbucks or bring your lunch to work or whatever. Those things don't work. Well, maybe they do. So if you say you got $100 a month in lunch money, right, that you take for lunch, and instead of that $100, you add that to your mortgage, that will save you more than $28,000 in interest over the life of your loan, right? And obviously, if you spend more on lunch money over the course of a month, and 100, it seems a little light over the course of a month, but if you spent even more eating out for lunch, then you could really be saving yourself a lot of interest over time. Something else that might help you pay it off early is to refinance, especially right now when rates are so low. And a lot of people have already gone and refinanced to a lower rate. But not only refinancing to a lower rate, maybe even refinancing to a lower rate and a shorter term mortgage. That way you're forced into paying the mortgage off earlier. But nonetheless, refinancing down to a lower rate is going to save you money. Just make sure that you leave plenty of room. And what I mean by that is when you refinance, it's going to be costly to you in some way. So you want to make sure that you are recouping that cost of the refinance in the amount that you are saving in your payment over time. And that's not taking forever to recoup that cost. So make sure that the refinance is not something down from 3.5 to 2.5, although that can be, okay, maybe, but let's say it's something where you've got like a 4 or 5, 5.5% mortgage. And you could get it now for 2.5%. That sounds really, really advantageous, and I would take advantage of that, and that will save you money and help you to pay your house off earlier, no doubt about it. And then you could also downsize your home. This is drastic, right? I don't want people to go and just downsize, right? But you may own a lot more home than you really need to, or you may have a mortgage on a lot more home than you need to because you don't own that home until you pay it off. But you may have a lot more mortgage than you need to have. So maybe you should downsize some and you can pay off a mortgage quicker with a smaller home. But that is a very drastic step. That's a very drastic idea. And I don't want you to do that unless your mortgage is eating your lunch. And that would be when it's like, closer to half of your monthly take-home pay. It can really get after you. And there's no way you're going to be able to put extra money on it because you don't have any extra money to put on it because it is taking up all of your free cash flow. Then obviously, if you are going to purchase a home, then something that you can do to decrease the amount of time it will take to pay off the mortgage and obviously decrease the loan value in the first place is to put down a bigger down payment. Now, down payments can be really costly. If you have never owned a home before, I'm perfectly okay with you putting down the minimum and beginning to build that home equity. And maybe you have PMI for a little while, but you can get out of that. But do that on a conventional loan and still try to do a 15-year loan and do that. And you can put down the minimum. But if you've already owned a home for some period of time, you need to be putting down at least 20% to make sure you stay out of the private mortgage insurance, the PMI, to where you're spending more on stuff that's not even going towards your principal and interest. And you can decrease your loan value and be able to have this smaller loan that you can throw more money at over time, which can be really advantageous and allow you to pay your mortgage off earlier. Look, there's a million ways that you can do it. There's a million ways that you can decide that I want to pay off my mortgage early, but you have to understand that until you make the call, until you decide that you really want to do it and you really want to be completely out of debt and you want to own your home outright, you are going to have some work ahead of you, and that is perfectly okay. But until you make that decision, until you say that, yes, I'm going to do it, it is going to be very difficult to you to get to your long-term financial dreams. If you're going to sit around with a 30-year mortgage for 30 years, that's going to be tough. If you're going to sit around and rent forever, that's going to be tough. I'm okay with you renting in the short term, but just not in the long term. Or if you're taking out more mortgage than you can pay for, then that's going to be tough for you as well. So I want you to be in the best financial position possible, and having a home that you own can help you be there, right? We talked about it. Millionaires own homes, right? Millionaires own this type of real estate. They own a primary residence. And in owning a primary residence and becoming a millionaire, that is what we want to do. We want to follow the footsteps of the people who have come before us and who have done the things that millionaires do, and owning a home is one of them. But we don't want to do it to where it's so costly to us to where we can't do the things that we need to do in our financial lives over time. So we need to do it the right way. We need to make sure that a home is a blessing and not a curse, because it can definitely be a curse. And we also need to understand why the home fits in the particular part of the financial action plan that it does. That way you can understand as you're working through the plan, they're like, hey, yeah, we want to get out of consumer debt and we want to get the home paid off, but those are two separate goals. And the reason that they are separate goals are, as I mentioned earlier, things like the home being an appreciating, not a depreciating asset, the home being so large, the payment being so high, and you're going to have to pay for it. So these types of things factor into how we go about treating this particular type of debt. And again, we don't like debt. We don't want to be in debt. So eventually we want to get out of this debt, and we want to do it in a reasonably short period of time. But we are not so just focused on that as we are, let's get out of consumer debt, because being out of other types of consumer debt is what's going to get you to long-term financial freedom, and is what's going to provide you the motivation and the confidence to be able to pay off your home early and do it in a way that most people don't believe is even possible. So thanks for tuning into this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, then be sure to subscribe and leave a review on either of those platforms, and that would be really helpful for me. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you with your financial plan, create a financial plan that is specific to you and your family's needs, and help you to walk through that plan over time, then I can help you to do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in Monday as I talk about the fact that what I am telling you and teaching you and preaching to you here is not the prosperity gospel, not in the slightest. And we'll talk about how this differs from what the prosperity gospel is, and why that is not what we are going after when we are trying to teach going for and reaching long-term financial success and long-term financial freedom. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.